Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine work back from variance analysis. If you are coming across my lecture for the first time, please make sure you like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. My lecture shall cover the general overview of variance analysis. I will solve questions from past ACCA examination, and the same question can be obtained from Workout Performance Management by Ade Omoleyiwa. Now, keep watching. So, I have in my earlier presentation, I've examined the elements of cost. Elements of cost, which include materials, labor, variable overheads, and fixed overheads. Each of these elements have their respective price and quantity variance. Price, so we used to buy material at a price. We talk about material price variance. You buy the price for labor is called rate. Variable overhead is an expenses, so we call it expenditure. Fixed overhead is also an expenses, so we call it expenditure variance. So that is the price variance. Then the quantity variance. You use material in production. You talk about usage variance. Then for labor, it is called efficiency variance. For variable overheads, it's also called efficiency variance. For the fixed overheads, it's called volume variance. The material price variance will be divided into mix and yield variance. Labor efficiency will be divided into composition variance and productivity variance. Then for fixed overheads, we have efficiency and capacity variance. Variable overheads, we have mix and yield as well, but these are the common ones. So my focus is on the work back from variance analysis. Before I go into it, I want to give you the general overview of all these variances. Number one element we are going to examine is materials. So we have material variances. Because you need all these formula to solve questions involving work back from variance analysis. That is why I want to go through them. Material price variance or material cost variance. Material cost variance. Remember, I've told you variance is the difference between standard and actual. If variance is equal to standard minus actual, therefore, material cost variance will be standard material cost minus actual material cost. This standard is a product of two standards. You have the standard quantity and the standard price. While this actual is also a product of two actual, which is actual quantity and the actual price. That is why I'll be saying for material cost variance, for standard material cost, it is the product of two standards, standard quantity times standard price. For actual material cost, it is the product of two actual, which is actual quantity times actual price. Therefore, material cost variance equal to standard quantity times standard price minus actual quantity times actual price. That is the formula. But I want you to take note. Anytime you are solving anything of variance, wherever you have standard quantity or standard hours, these two items should always be flexed. They should be flexed. By flexing them, it means you multiply these items by actual production. actual production. Actual production is different from actual quantity. Production is the output achieved, while quantity is the raw material used in production. So there are difference between standard quantity of production and actual production. Actual production, you are talking about the actual output achieved. High title, I'll be putting, anytime you see standard quantity or standard hour, you only put based on actual production. BOAP. It means based on actual production. Based on actual production means you multiply each of the items, because you'll be given on a unit basis, you multiply them by actual production. Don't confuse your standard with budget. A standard is a unit cost concept. Budget is a total cost concept. If you are given budget, you will need to convert that budget to standard before you can solve anything involving variance. Budget is total, standard is for a unit. That is why I said a budget is a total cost concept, while standard is a unit cost concept. Take note of that. Then this material cost variance can be divided into two. Material price variance. Price variance. Material price variance. Material price variance. Invariance. Invariance is standard minus actual. So since you are focusing on price variance, you consider standard price minus actual price. This will be the variance in or on a unit price. Then if you now multiply it by the total quantity purchased, actual quantity purchased, I mean. So material price variance is standard price minus actual price multiplied by actual quantity. What am I trying to say? You know, price variance falls in this category. Anything, anytime you are calculating anything under this heading, the weight should be quantity, and the quantity to use must be actual quantity of the element. Actual quantity. If you are calculating anything under the quantity variance here, the weight should be price, but the price to use must be standard price of that cost element. Standard price. Take note of that. Since we are calculating price variance, that is why we have the weight as the actual quantity. As I have said, actual quantity. That is what we have as the weight here. The actual quantity purchased. Now, this AQP stands for actual quantity purchased. The SP stands for standard price. And the AP stands for actual price. Remember, price is for a unit. Price is for a unit. Number 3, we have material usage variance. Material usage variance. Material usage variance. So, remember, the usage variance is under quantity variance. That means what we want to compare is standard quantity and actual quantity. Remember, I've told you earlier that variance is the difference between the standard and actual. Therefore, you have the standard quantity minus actual quantity. Standard quantity minus actual quantity. But remember, I've told you earlier that if you are calculating anything under the quantity variance here, you use price as the weight. The price to use as weight must be the standard. That is why we'll be having the standard price as the weight multiplied by the standard price. That is for the material usage variance. The second category is labor variances. Labor variances. So, number 1 variance under labor we'll be examining is labor cost variance. Labor cost variance. Labor cost variance or direct labor cost variance. So labor cost variance, since it is a cost variance, variance is standard minus actual. Therefore, it will be standard labor cost minus actual labor cost. I have told you the standard is product of two standards, which is standards, while actual is product of two actuals, which is actual. So remember labor. So it is measured in hour. We have standard hour, and this will be standard rate. Why this will be actual hour, and this will be actual rate. Remember, I've told you that these two items should always be flexed: the standard hours and the standard quantity. That is, you multiply it based on actual production. That is why I be adding BOAP based on actual production. Therefore, labor cost variance equal to standard hours based on actual production multiplied by standard rate minus actual hours multiplied by actual rate. Then number 2, we said the labor cost variance will be divided into rate and efficiency. What is labor rate variance? Labor rate variance labor rate variance. Since it is rate, no, variance is standard minus actual. So it will be standard rate minus actual rate. Remember, I've told you, if you are calculating anything under the price variance, that the weight should be the actual quantity of that element. The actual quantity of labor is measured in hour. So we multiply by actual hours paid for. So the SR stands for standard rate. The AR stands for actual rate. And the AHP stands for actual hours paid for. The hours paid for may not be the same as hours worked. So if the hours paid for is more than the hours worked, that means there is an idle time. Idle time is the number of hours in which the workers are not engaged. It may be as a result of machine breakdown or power failure. Therefore, this is the formula for calculating labor rate variance. Then we also have quantity variance for labor, which is efficiency. So we have labor efficiency variance. Efficiency of labor is the quantity variance. Labor efficiency variance is the quantity variance for labor. Labor efficiency variance being the quantity variance for labor, and the quantity of labor is measured in hour. So that means if variance is standard minus actual, you'll be having standard hour minus actual hours. Remember, I've told you you should always place this based on actual production. Multiplied by, I've told you if you are calculating anything under the quantity variance, that the rate should be the standard price of that element. The standard price of labor is in rate, so we multiply by standard rate. So this is actual hours worked. Actual hours worked. And this will be actual hours paid for. You can add W to this to mean the actual hours worked. But I've told you, actual hours worked and actual hours paid for may not be the same. And if there are variants between them, we call that variance an idle time. So we have idle time variance. An idle time variance is always an adverse variance. Idle time variance. Idle time variance is the difference between the actual hours worked and the actual hours paid for multiplied by the standard rate. Since idle time variance is under quantity variance, that is why we still have the weight to be the standard rate. This is AHW is the actual hours worked, while AHP is the actual hours paid for. The third category, we have variable overheads variances. Under this, we may examine variable overheads cost variance. Variable overheads cost variance. Variable overheads cost variance. Since variance is standard minus actual, it will be the difference between the standard variable cost, standard variable overheads cost, minus actual variable overheads cost. Remember, I've told you standard have two legs. What are the two legs of the standard? Standard hours and standard rate. I am using hours since the same hour is used for labor and overheads. So actual hours and actual rate. So this one I've told you standard hours and standard quantities should always be flat based on actual production. Therefore, variable overheads cost variance equal to standard hours based on actual production multiplied by standard rate minus actual hours times actual rate. So that is the formula for calculating the variable overheads cost variance. The variable overhead cost variance, I said it will be divided into expenditure variance and efficiency variance. Variable overheads, expenditure variance. Variable overheads, expenditure variance. So it is price variance. Same rate with the price variance for variable overheads being expenditure, we still use to call it rate. So it will be the difference between standard rate, that is standard variable rate, if you like, you may add B to it, minus actual variable rate multiplied by actual hours worked. It is the actual hours worked that will be used, not paid for. That is the variable overheads expenditure variance. Number 3, we have variable overheads efficiency variance. Efficiency variance is the quantity variance for variable overheads. It is the quantity variance for variable overheads. Being a quantity variance, the quantity is measured in hours. So variable overheads efficiency variance, the quantity is hours, standard hours minus actual hours multiplied by the standard variable rate. This standard hours must be based on actual production. Actual production. So these are the formula we have under variable overheads variance. Then we have fixed overheads. Fixed overheads variances. Fixed overheads variances. That is number 4. Under this, we will examine fixed overhead cost variance. Fixed overheads cost variance. Fixed overheads cost variance. This will be standard fixed overheads cost minus actual fixed overheads cost. I've told you this standard have two legs, standard hours, standard rate, standard. The actual have two legs, actual hours and the actual rate. So this will be flexed based on actual production. Therefore, fixed overheads cost variance will be standard hours based on actual production times standard rate minus actual hours times actual rate. Alternatively, let me give you another formula for this. You may have fixed overheads absorbed. Fixed overheads cost variance is fixed overheads absorbed minus actual fixed overheads. Actual fixed overheads. Fixed overheads absorbed will be standard rate per unit. This is rate per hour because this is hour. Then this will be standard rate per unit multiplied by actual production, which is standard rate per unit multiplied by actual production. That will give you fixed overheads absorbed minus actual fixed overheads, which is actual hour times actual rate as before. The standard rate per unit, I want you to take note of this. The standard rate per unit equal to standard rate per hour multiplied by standard hour per unit. So this will give you this. I want you to take note of all this formula. Number 2, fixed overhead expenditure variance. Fixed overhead expenditure variance. Being an expenditure, another word for it is fixed overhead budget or fixed overhead budget variance. Fixed overhead budget variance. Being a budget variance, you want to compare budget with actual. Fixed overhead expenditure variance equal to budgeted fixed overheads. Budgeted fixed overheads minus actual fixed overheads. What is budgeted fixed overheads? Budgeted fixed overheads. Budgeted fixed overheads equal to budgeted hour times standard rate per hour. Budgeted hour times standard rate per hour. Where budgeted hour equal to standard hour times budgeted production. BP stands for budgeted production. That is budgeted output. Budgeted production or budgeted output. This is standard hour per unit as before. Standard rate per unit. Standard rate, this is standard rate per hour. So take note of all these formula. Number 3, we said the fixed overhead expenditure, fixed overhead is divided into expenditure and volume variance. What is fixed overhead volume variance? Fixed overheads volume variance. Being a volume variance, we are talking about the level of output achieved, which is budgeted production minus actual production times, this is production per unit, which is in units, not hour. So this weight will be standard rate per unit. I've told you standard rate per unit. Standard rate per unit equals to standard, where is it? Yes, this is standard rate per unit, which is standard rate per hour times standard hour. This will give you standard rate per unit. So it is standard rate per unit unit here. This BP stands for budgeted production. As usual, budgeted production. AP stands for actual production, like before. Actual production. Take note of all this. I've told you that fixed overhead volume variance is divided into 2. Fixed overhead efficiency variance and fixed overhead capacity variance. So, efficiency is always efficiency. That is the fourth variance under fixed overhead. So fixed overheads, efficiency variance. Fixed overheads, efficiency variance. Efficiency is also measured in hours, which is standard hours minus actual hours multiplied by standard rate per hour. This is rate per hour. This is always flex based on actual production. That is fixed overheads efficiency variance. Number 5 variance I'm going to examine is fixed overheads capacity variance. Fixed overheads capacity variance. Fixed overheads capacity variance, which is the difference between actual hour minus budgeted hour multiplied by standard rate. This will be rate per hour since this is in hour. Take note of this. These are the formula we have for fixed overheads. Then before I take a work example from ACCA examination, and I've told you the same question which I'm about to use as work example can also be found in Workout Performance Management by Ade Omolehiwa. Sales variances. Sales or revenue variances. So this sales variance, we will divide it into two: the price variance, sales margin price variance, and sales margin volume variance. This volume variance is divided into mix variance and quantity variance. But I'm not going to consider that in this video. I have that in my earlier video. So this volume variance will be computed in two different schools of thought under marginal costing. School of thought and absorption costing. Absorption costing. These are the two separate schools of thought under which sales volume variances may be computed. So, what is sales margin price variance? Sales margin price variance. Sales margin price variance. Sales margin price variance, which is the difference between the standard selling price, if variance is standard minus actual. Standard selling price minus actual selling price multiplied by actual quantity sold. SSP, standard selling price. ASP, actual selling price. AQS, actual quantity sold. Take note of this. Then I've told you we have sales volume variance. 2. Sales volume variance. We have under marginal costing, school of thought. Sales volume variance, which is the difference between budgeted quantity minus actual quantity sold multiplied by standard contribution. The BQ stands for budgeted quantity. AQS still remain as before. Then we also have sales volume variance under absorption costing, school of thought. That will be sales volume variance. That will be budgeted quantity minus actual quantity sold. Those variables will be the same under both methods. multiplied by standard profit. Standard profit. Remember, contribution is selling price less variable cost. Selling price less variable cost per unit. Example, as a recently appointed assistant management accountant, you are attending a monthly performance meeting. You have with you a statement of monthly actual costs, a summary of cost variances, and other pieces of information you have managed to collect as shown below. Actual cost of direct material purchased and used, 62,700. Actual direct wages paid, 97,350. Variable overheads incurred, 19,500. Fixed overheads incurred, 106,500. Direct material price variance, 5,700 adverse. Direct material usage variance, 3,000 favorable. Direct labor rate variance, 1,650 favorable. Direct labor efficiency variance, 9,000 favorable. Variable overheads variance, 1,500 adverse. Fixed overheads expenditure variance, 1,500 adverse. Fixed overheads volume variance, 15,000 adverse. The actual wage rate paid for the period was 8.85 per hour. It takes 3 standard hours to produce 1 unit of the finished product. The single direct material used in the period cost 30 kobo per kg, above the standard price. 5 kg of raw material input is allowed for as standard for 1 unit of output. All figures relate to the single product which is manufactured at the plant. There were no stock at the beginning or end of the accounting period. Variable and fixed overheads absorption rates are based on standard hours produced. Managers from various functions have brought to the meeting measures which they have collected for their own areas of responsibility. In order to demonstrate the link between the accounting values and their measures, you have decided to work from the variances to confirm some of them required. A. Using variance formula, determine 1. The actual number of direct labor hours worked. 2. The standard rate of pay per direct labor hour. 3. The standard hours of production. 4. The actual production in units. 5. The actual quantity of direct material consumed. 6. The actual price paid for the direct material per kg. 7. The standard direct material usage in kg for the actual number of units produced. B. From A above and any other calculations which may be appropriate, compute the standard cost per unit of finished product. Show separately the standard prices and the standard quantities for each element of cost. Now, let's have the solution to the question. Solution. From the requirement A1, using the variance formula, determine the actual number of direct labor hours worked. We want to determine the actual number of direct labor hours worked. Actual number of direct labor hours worked. Let's look at the available information. To calculate the actual number of direct labor hours worked, let's look at the available information. We are given the actual wages paid of 97,350. So, if you look at the variances given, you are given direct labor rate, direct labor efficiency. We are not given the idle time variance. Since there is no idle time variance, that means the actual number of direct labor hours worked will be the same as the actual number of direct labor hours paid for. So, in this case, you are given the actual wages. The actual wages is the same as actual direct labor cost, 97,350. Remember the actual cost. I've told you the actual labor cost. I say it is equal to actual hours times actual rate. And you are given the actual labor cost of 97,350 equals to, you want to calculate the actual hours. Then are we given the actual rate? Go back to the question. The actual wages rate paid for the period was 8.85 per hour. The actual rate is 8.85 naira. Let's make actual hours the subject of the formula. AH will be 97,350 divided by 8.85. If you divide both sides by 8.85. 97,350 divided by 8.85, that gives us 11,000 hours. Therefore, actual number of direct labor hours worked, actual number of direct labor hours worked is 11,000 hours. That is the solution to the first part of the question. Roman figure 2. Now, you are told to calculate the standard rate of pay per direct labor hour. You want to calculate the standard rate, standard labor rate. Now, let's make use of labor rate variance from labor rate variance. The formula is labor rate variance, which is standard labor rate minus actual labor rate multiplied by actual hours. Are we given the labor rate variance? Back to the question. You have direct labor rate variance, 1,650 favorable. I've told you that a favorable variance is a positive variance, 1,650. It's a positive variance. And if you have an adverse, it will be negative. So what is the standard rate? Remember, you have to calculate the standard rate. That is what we are looking for. Minus actual rate. Actual rate as given in the question. The actual wages rate paid for the period was 8.85. So actual rate 8.85 multiplied by actual hours as calculated in Roman figure 1, which is 11,000 hours. So let's make this the subject of the formula. You either put the bracket by multiplying each of the elements in the bracket by 11,000. You have 11,000 times SR, it will be 11,000 SR, then 11,000 times 8.85. You now equate it to this. Or you divide both sides by 11,000. So the approach I will choose is to divide both sides by 11,000. Divide both sides by 11,000. You divide this by 11,000, 1,650 divided by 11,000, that gives us 0.15 equals to, if you divide this by 11,000, 11,000 will cancel here. We'll be left with SR minus 8.85. Then make SR the subject. So our SR will be 0.15. If this one joins this, the minus becomes plus 8.85. Let's add it. Therefore, SR equals to 9 naira. So, you have to calculate SR, that is the standard rate of pay per direct labor hour. Therefore, the standard rate of pay per direct labor hour is 9 naira. That is the solution to Roman figure 2. Then 3. Back to the question. You have to calculate the standard hours of production. The standard hours of production. Let me use of labor efficiency variance, standard hours, from labor efficiency variance. Remember labor efficiency variance, I said it is standard hours based on actual production minus actual hours multiplied by standard rate. You have to calculate the standard hours of production. That is, you have to calculate this. And what is our labor efficiency variance? Back to the question. You are given direct labor efficiency variance, 9,000 favorable. So our labor efficiency variance is a favorable variance of 9,000, which is a positive variance, equal to standard hours. That is what you have to look for based on natural production, minus the actual hours as calculated from Roman figure 1, which is 11,000 hours. So we now have 11,000 hours multiplied by standard rate. The standard rate is 9 naira as calculated. So you want to make the SH the subject. So you divide both sides by 9. Let's divide both sides by 9. So if you divide this by 9, it will be 1,000 equals to, if you divide this by 9, the 9 will cancel here. You'll be left with SH minus 11,000. To make SH the subject, we have SH equals to 1,000. When this minus 11,000 joins it here, the minus becomes plus. So we have plus 11,000. So SH equals to standard hour. That is 1,000 plus 11,000, which is 12,000 hours. Therefore, standard hours of production. Standard hours of production is 12,000 hours. 12,000 hours. That is the solution to Roman figure 3. Back to the question. In Roman figure 4, you are to determine the actual production in units. In 4, you want to determine the actual production in units. Actual production in units. Remember, in the Roman figure 3 just calculated, the standard hours of production. Standard hours of production, this is based on actual production. I said it's equal to standard hours per unit times actual production. And it is the actual production that is required here. So that means we can make use of this. And what is the standard hour? Back to the question. The standard hours, it takes 3 standard hours to produce 1 unit of the finished product. So the standard hour for a unit is 3. So if that is 3, then we now have, let the actual production be X. Let the actual production be X. If that is X, so standard hours of production now will be 3 standard hours based on actual production. That will be 3 times X, which is 3X. So our standard hours of production is 3X. And the standard hours of production has been calculated, and we got 12,000 hours in Roman figure 3. So now, let's equate that to 12,000. 3x equals to 12,000. To solve for x, you divide both sides by 3. So x will be 12,000 divided by 3. Therefore, x is 4,000 units. Therefore, actual production is 4,000 units. That is Roman figure 4. Number 5, you have to calculate the actual quantity of direct material consumed. The quantity consumed is the same as quantity used. You want to compute the actual quantity used in production. So now let's work back from material price variance. From direct material price variance. And the formula is direct material price variance, which is standard price minus actual price multiplied by actual quantity. This is what is required. Then we are given direct material price variance. Direct material price variance. Direct material price variance 5,700 adverse. This is given. Then standard price. Are we given the standard price for direct material? Let's go back to the question. You were told the single direct material used in the production in the period cost 30 kobo per kg above the standard. That means the actual price is 30 kobo greater than the standard price. It costs 30 kobo per kg above the standard. So if the standard price, let the standard price be X. If the standard price, let the standard price be X, then that means actual price will be X plus 30 kobo, which is 0.3. This is the actual price. Then we've know this, then you have to calculate this. Direct material price variance is equally given. Now, how much is our direct material price variance? It's 5,700 adverse. An adverse variance is a negative variance. Therefore, we are going to attach minus sign to it because it is an adverse. Remember, I've told you that a favorable variance is a positive variance, while an adverse variance is a negative variance. Please take note of that. The standard price is X. SP is X minus actual price. Actual price is X plus 0.3. That is the actual price. So the standard price is X. Actual price is X plus 0.3. Everything multiplied by actual quantity. Now let's open the bracket. We have minus 5,700 equal to X minus X. If you open this bracket, then minus will affect this plus. It becomes minus. Minus is 0.3. Everything multiplied by AQ. So X minus S, that is gone. You'll be left with minus 5,700 equals to minus 0.3 times AQ, which is minus 0.3 AQ. Therefore, to solve for AQ, divide both sides by minus 0.3. So AQ will be 5,000 minus 5,700 divided by minus 0.3. Therefore, AQ, actual quantity. So if you divide that, 57 divided by 0.3, that gives us 19,000. Minus, we cancel minus. So you have 19,000 kilograms. Therefore, actual quantity of direct material consumed is 19,000 kg. 7, you have to determine the standard direct material usage in kg for the actual number of units produced. That is standard quantity based on actual production. Standard quantity based on actual production. Number 7, so you want to determine the standard quantity. 7, standard quantity of actual production. That is what is required, which is standard quantity times actual production. That is the requirement in 7. And how much is the standard quantity? I think that has been determined. Okay, the actual production has been calculated and we got 4,000 units. Then I will give you the standard quantity. Back to the question. 5 kg of raw materials input is allowed for as standard for 1 unit of output. So 5 kg. The standard quantity is 5 kg. Actual production is 4,000 units. So if you multiply that, you have 20,000 kg. That is the answer to the number 7. Now, the B part of the question, from A above and any other calculations which may be appropriate, you have to compute the standard cost per unit of finished product. Now, we want to prepare the standard cost card. Standard cost card. Standard cost. The first element we have materials. We have price. We have quantity. What is the standard price for a unit of material? You are given the standard quantity of material. The single direct material used in the period cost is above the standard price. 5 kg of raw materials input is allowed. The standard quantity is 5 kg. Then what is the standard price? You were told the single direct material used in the period cost 30 kobo per kg above the standard. If it is 30 above the standard, that means it is 30 kobo more than the standard. Therefore, what would be the standard price? We know the actual price. The actual price is 3 naira 33 kobo. 3 naira 30 kobo. If it is 30 kobo above the standard, that means the standard price will be 3.30 minus 0.3, which is 3 naira. This is 0.3 is the 30 kobo here. Convert kobo to naira. 100 kobo make 1 naira. 30 divided by 100, it will be 0.3. So you were told it is 30 kobo per kg above the standard. That is why I subtracted the 0.3 from the actual in order to get the standard. Therefore, the standard cost will be 15 naira. 3 times 5, 15. Then direct labor. You were told the actual wages paid for the period is this. This is the actual. It stays 3 standard hours. So the standard hours for labor is 3 hours. Then we need the standard price. And how much is the standard price for labor? Labor rate, the standard rate is 9 naira as calculated earlier. So the standard rate, no, the price for labor is usually called rate. So we have 9. 9 times 3, that will be 27. Then after direct labor, the next item is variable overhead. Variable overhead. The same hour used for labor is usually used for overheads. Then we are left with standard rate for variable overheads. We need the standard variable overheads rate per hour. So now let's look at the available information. We are given variable overheads in Kion, 19,500. This is the variable overheads cost. Then the variance we are given variable overheads variance. This is the variable overheads cost variance. And the variable overheads cost variance, variable overheads cost variance. That will be standard variable cost minus actual variable overhead cost. I've told you that the standard variable overhead cost is standard hours times standard rate minus actual variable overhead cost, which is actual hours times actual rate. And this is even given directly in the question. The actual variable cost is given directly in the question. We are given variable overhead cost variance. The variable overhead cost variance we are given is variable overhead variance 1,500 adverse. So it's an adverse variance of 1,500. I have told you that an adverse variance is always a negative variance. So we have minus 1,500 equals to, what is the standard hour? Standard hour is 3 hours as before, based on actual production. I've told you, you always place your standard hour and the standard quantity based on actual production, and the actual production has been calculated earlier, and we got that to be 4,000. So we have multiplied by 4,000. This is the standard hours of production multiplied by standard rate. That is what we are looking for. Minus, this is actual variable cost, and the actual variable cost is given to be 19,500. So we have minus 19,500. So we collect the like terms. Minus this and this are like. So you have minus 1,500 plus 19,500. This minus becomes plus when this comes here to meet this. Equals to 3 times 4,000, that is 12,000 standard rate. So minus this plus this, it will be plus 18,000 equal to 12,000 standard rate. To get the standard rate, divide both sides by 12,000. So the standard rate will be 18,000 divided by 12,000. Therefore, the standard rate for variable overheads will be 18,000 divided by 12,000. That gives us 1 naira 50 kobo. So 1 naira 50 kobo, that is the variable overheads rate per hour, 1 naira 50 kobo. Multiply by 3 hours. So we have 4 naira 50 kobo. Then, after variable overheads, we have fixed overheads. Fixed overheads. Same hours will be used, which is 3 hours. Same hour for labor and overheads. Then we are left with standard rate per hour. But we are given the fixed overheads incurred, 106,500. This is the actual cost for fixed overheads, that of the variable overheads. Then for the fixed overheads, let me have that to be working too. You need the standard fixed overheads rate. Now let me use our fixed overheads cost variance. We are able to make use of the fixed overhead cost variance because you are given the fixed overheads incurred. You are given the amount incurred. This is the actual. Remember, fixed overheads cost variance is the difference between fixed overheads absorbed, fixed overheads absorbed, fixed overheads absorbed, and the actual fixed overheads. So the difference between the two, that will give you the fixed overhead cost variance. But we are not given fixed overhead cost variance. We are given fixed overhead expenditure variance and fixed overhead volume variance. The fixed overhead cost variance will be the sum of the fixed overhead expenditure variance and the fixed overhead volume variance. Therefore, fixed overhead cost variance 1,500 adverse plus 15,000 adverse. That will be 16,500 adverse. So fixed overheads cost variance. Now 1,500 plus 15,000. That will be 16,500 adverse. If fees over head cost variance is 16,500 adverse, and adverse variance is always negative, equal to fees overheads absorbed. To absorb fees overhead, we make use of fees overhead absorption rate. Fees overhead absorption rate multiplied by the actual hours or actual production. Actual production. And the actual production has been calculated earlier. Actual production, we got 4,000 units. So, fees overhead absorption rate times 4,000 units. That will give you the fees overhead absorbed minus actual fees overheads. Actual fees overheads incurred. Fees overheads incurred 106,500 minus 106,500. So you collect the like terms. This and this are like. Minus 16,500 plus 106,500 equal to 4,000 fees overhead absorption rate. Minus 16,500 plus 106,500. This gives us 90,000 equals to 4,000 fees overhead absorption rate. So, our fees overhead absorption rate will be 90,000 divided by 4,000. That gives us 22.5. 22 naira 50 kobo. That is the fees overhead absorption rate. This is the rate per unit because it is unit we use here. To get the rate per hour, fees overhead absorption rate per unit, that will be standard rate per hour times standard hour. And this is 22.5 equal to standard rate per hour. That is what we are looking for. Times standard hour. What is the standard hour? You were told it takes 3 standard hours to produce. Remember, I've told you same hour is used for labor and overheads. Therefore, to get your standard rate per hour, you have 22.5 divided by 3. Therefore, the standard rate per hour, that will be divided by 3. That gives us 7 naira 50 kobo. 7 naira 50 kobo. That will be used here. 7 naira 50 kobo. 7 naira 50 kobo multiplied by 3 hours times 3. Then we have 22.5. 22 naira 50 kobo. So we've dealt with all the cost elements. So we now sum up everything in order to get the standard cost. Now let's sum them up. 22 naira 50 kobo plus 4 naira 50 kobo plus 27 naira plus 15 naira. And that we have 69 naira. So that is the end of the solution to the question. Now let's go back to the question to see if there are further information. Show separately the standard price and the standard cost. So this marks the end of the solution to the question. Please drop the love emoji. Also share the video with others. Thanks for watching ZICA.